ask people if they're willing to give their name, rank, and serial number. If you just give your name and what unit you're in, or if you're from the community, that will help Paul in terms of knowing with whom he is speaking as we go forward. So, if you could begin.
Gosh. I'm the lost person. My name is Sherry Pugh, and I'm an alumni of the Humphrey School from the class of 2012. And currently, I'm retired.
So
and I do some consulting in community economic development.
Well, we're glad to have you here. Glad you're here, Sherry. Thank you for coming, Sherry.
And I'm Lara's host family.
Oh,
good afternoon. My name is Puttama. I'm from Laos. I'm the Humphrey Fellowship Program.
Oh, good.
Good. So very glad to be here today and want to learn from the presentation and the discussion today. So, yeah.
You will probably be surprised, or maybe not, that I've been associated off and on with that program since 1979.
Wow.
Actually, it didn't really start until 1980, but it was
Right.
conceived in the late Carter administration.
Hello, my name is Stasha Lokic. I'm from Serbia, and I'm like Lara, Hubert Humphrey Fellow.
Well, that's
Yes. Actually, I don't work in private sector. I'm not so familiar with this subject. I'm civil servant at the government of Serbia and Ministry of Public Administration, but that is another reason why I'm here.
Well, this has great public policy implications, this whole
Yeah.
subject, so thank you for...
Policy issues I have dealt for the last 15 years throughout my civil service career. So I hope that something which I get is very crucial to me.
Good. Excellent, that's wonderful. Glad you're here. This man I know.
Hi, I'm Vaaler. I'm a second year in between Humphrey School. I'm interested in looking at development and political economy of growth.
Great.
So anything that relates distinctly to any sort of development, that still I find it still interesting.
Well, it'd probably be a good guy for you to get to know better, so it's great to have you here.
Hello, my name is Subi Lee, and I'm a first-year Master's of Public Policy student. I am the Global Programs Assistant, and I am interested in economic development as well, so I'm here.
That's great, Sue, and it's good that you're willing to help us out with this. And you, sir?
Hello, I'm Wan Haodong, from China, Shanghai. I'm a business scholar at Humphrey School.
Yes, of course.
And my major in public finance.
Excellent. Yes, you and I met last week.
That's
right. Welcome. Well, great to have you all here. I'm Bob Cooderly. This seminar has been going on for a number of years. We have a lot of different topics. We have a different group every year, every week, or every 2 weeks, because it meets every other Tuesday. And we never know quite how many people are going to come or who they're going to be. So it's really interesting for me to see how the group changes from topic to topic. But we're honored today to have somebody who's an old friend of this group, Paul Vaaler, from the Carlson School and the Law School. Paul is trained both in the field of management, in which he has his PhD from this university, and also in law from the Harvard Law School, practiced law, worked as a graduate student, got his PhD, was on the faculty of the Tufts Fletcher School, as well as the University of Illinois, before he came back to us, and we were all delighted that he did come back to us a few years ago. And he was just last year named the inaugural holder of the John and Bruce Moody Chair in Law and Business at the University of Minnesota Law School. So he's now dividing his time between our business school, the Carlson School, and the law school, and he's an affiliated fellow of the Oxford University Said Business School as well. Paul works in the area of business, law, and politics in a wide variety of subjects, which I won't recount in detail. But some of his research, and he does a lot of different things, has recently involved this issue that he's going to be talking with us about today: slack resources, stakeholder regulatory protection, and innovation by firms around the world. So Paul, welcome. It's always great to have you.
Thanks. Thank you, Bob. And I'm really glad all of you are here. It's we're a relatively small group, but I would say quite diverse in terms of where we're coming from. And it's something I'm familiar with. As Bob mentioned, my first job out of graduate school was not at a business school or, for that matter, a law school, nor was it in at least a more generic public policy school. It was in a school of international affairs. So I'm very used to having more than half of my students not be native-born U.S., coming from all around the world, including Thailand and Laos and other parts of Southeast Asia and Africa and China. So I'm feeling at home. So thank you all for being here. And I want to emphasize that what I'll talk about today is something which I think is relevant primarily to what we do in the business school, just right next door to us here at the Humphrey School, but has very, I think, substantial implications for public policy. And as we go along, I'll try to point out where I see those, starting with the kind of theoretical motivation for this. But then I'll leave some time for us, I hope, to comment on some of the important public policy implications that I think come out of this study. We sit in different parts of the university, and we're defined in part, I think substantial part, by where we sit, college-wise. But we're part of a bigger university. And the most interesting questions we address, academic research questions, their policy, prescriptive implications, are the ones that cross borders, that cross college borders. And I think this is one of those questions. But we'll leave that to you. A couple of things. Different people have different presentation styles. My own is one where I welcome any questions that come along the way. What do you mean by that? Or, I don't understand that chart, or what you just said. Please stop me. Raise your hand, just comment. We're a small enough group that I'll try to make sure I can answer your question and keep the presentation going forward. And then I'll try to leave a few minutes at the end for us to talk about what just went on. So, with that in mind, what I like to do often is say, here's what I'm going to tell you. And this is all in one little slide. It's the nutshell. It's the research in a nutshell. And I'm going to throw some words at you that have sound like 25-cent phrases that you go, what does that mean? But they really get after things that are intuitive. So the first is, I'm going to use a phrase, behavioral theory of the firm, or the acronym BTF. And if you're over in the business school, you're super familiar with that. It's one of the most powerful, popular, and long-standing theoretical lenses for understanding how firms work. But in a larger sense, it's that same kind of lens for understanding how organizations, whether they're in the private sector like firms, or in the public sector like government agencies, or in the civil society sectors, non-governmental organizations. This BTF, or behavioral theory of the firm, has as one of its featured components of its theory something called SLAC, or SLAC resources. And like the word suggests, it's those things we don't need every day to work in our organizations, but sit off on the side or in the offing. There are the extra resources that allow us to take risks, to do things that are good for the long term, but may not necessarily help us right away. So SLAC resources in the BTF are fundamental to understanding why certain firms innovate more or less. And if you want to move that to other organizations, they're fundamental to understanding why certain government agencies invest more in new products and services, or why certain NGOs, non-governmental organizations, do that. That's the simple idea. SLAC motivates innovation. The not so simple, or at least sometimes contradictory finding is that that simple idea doesn't always travel well across countries. And by that I mean, when we do research on the relationship between the availability of SLAC, those resources that we don't need today, and innovation by firms, sometimes we see the relationship lining up the way it should, positively. More SLAC, more innovation. And other times we find no relation or the opposite. And what's interesting about it is that correlation has to do with the geographic site of where that research is done. This is a theory that comes out of the US from the 1960s, but it's one, to the extent there is international research, it's contradictory or inconsistent. So that's the motivation for this work, is how would I explain why sometimes it works and sometimes it doesn't, sometimes it works weakly, sometimes it works with a vengeance. And we think we have an answer. My co-author, a former doctoral student of mine, Joel Malin, who's a native-born US, but he works in a Japanese university business school at Totsubashi. He and I have what we think is an interesting theoretical explanation for it, and then interesting evidence. And the basic theoretical explanation is that there are things that are going on in the firms that are quite consistent with the basic idea that more slack up to a certain point leads to more innovation. At some point you can have too much of a good thing, and the outcomes are decreasing, but we have that positive relationship. And here's the trick. The country level factors, where the firm is located, country level factors, especially the regulatory factors that have to do with how powerful your shareholders are in firms, how powerful your employees are in firms, have a lot to do with moderating that positive effect. So more slack leads to more innovation in firms, but if that firm is in countries where they give shareholders tremendous power, that positive effect is diminished. It may be diminished, it's zeroed out altogether. And in the context of stronger employee rights, if that firm is investing in slack, and it's a certain kind of slack, and you protect those employees so it's harder to fire them, harder to move them about, or you might say they're more empowered, then we observe that that slack effect in innovation is magnified. It's almost like it's on steroids. And I'm going to talk more about how that works, but think of a world where you have firms and firms in countries, like a cross-level framework. And we develop a series of predictions about how we think slack affects innovative effort in firms on its own, and then how country-level regulatory factors moderate that, either magnify or diminish that. And then I'm going to show you some evidence. I'm going to show you evidence from observing and analyzing thousands of firms located in a couple dozen or so countries, about 20 to 29 countries, observed over about 16, 17 years, from about 1990 to 2006. And what I'm going to show you is how you tease out the firm level effects, that positive relationship between more slack and innovation. And then, maybe the trickier part, how you also then sequentially tease out the country level effects, that magnifying or diminishing effect. And if what I'm doing for you makes sense, has that validity about it, reliability about it, then what I think we're doing is we're explaining that conundrum about why this theory doesn't appear to travel so well. And the reason is because we don't take into account the institutions, especially the legal and regulatory institutions that differ across countries, whether that firm's in China or Laos or Serbia or India or the United States. And these are important differences because, as we know, regulations of shareholders, the protections they get, and of employees, they're substantially different if you cross borders, and they don't show any signs of convergence to one world government on it. So these differences explain that variation, they help explain this mystery about the behavioral theory, and they help that theory. The theory is about 50 years old, and they help it become easier to travel and maybe better for international research, the kind of research that finds its way into this seminar, the kind of research that finds its way into the Humphrey School increasingly, and I think is important also to the Carlson School and elsewhere. Also, it has one policy element, and that is, I think an important policy element, is that, especially with regard to this effect I'm going to show you for employees, if you protect employees more, there seems to be a magnified effect of innovation effort for an extra unit of slack. That has really implications for education policy and indeed industrial policy inside of countries. And I'm going to talk about that because you can interpret these results a couple of different ways. One, quite optimistically, hey, we should be investing in our education, especially worker education. Another one, a cynical approach, which says, this is just about how we throw resources at people we can't fire. And I'm going to try to distinguish between that cynical and optimistic approach and give you a sense of what the implications are. So that's what the research is about. That's if we stop it now, you get at it. And it's really quite intuitive in many ways. So let me just set this up a little bit. This is a picture of a book called The Behavioral Theory of the Firm. It's the front cover from the mid-1960s, 1963, I think it is. And two guys, Jim March and Dick Sire, out of the Carnegie School, the Carnegie University out of Pittsburgh, are the purveyors of that. And it's a long, great tradition of research. It really just says organizations, whether they're firms or elsewhere, are sociological bodies. They're given to the limitations that come with individuals and groups, and therefore they deviate from, if you will, a kind of rational neoclassical economic view of the firm. It's nothing more than a production function. People are something more than less than hyper-rational. They try their best, but with limited capacity. And so there are a number of really interesting implications about a behavioral theory of an organization, including the firm. And this field, spawned largely by this book, and by these two, Jim March and Dick Sire, is really one of the dominant fields, important fields in management and related fields, including here at the Humphrey School in the study of public organizations. The early findings with regard to that claim about Slack resources, resources that are in the offing, that are there to help support you when you're doing long-term projects and things are volatile in this world, so not surprisingly tells you that more of it's better, right? If you have more of this Slack, there's more innovative activity going on. Maybe at a certain point, at some point you have diminishing returns for this, it's curvilinear. A little more recent research in the 1980s and early 90s said it's important to distinguish between different kinds of Slack. There are Slack resources that are really flexible, cache, securities, things that are easy for us to liquidate if we need to, if we need times change. And there are kinds of Slack that are absorbed. They're in plant, property, and equipment, or people. So if things don't go out the way you think they should, then you're to some extent committed. They're more narrow in their ability to buffer your activities and that volatility because they're harder to liquidate, right? You can't just fire people, often the case, or you can't just liquidate plant, property, and equipment. So that's important. And then I think, there are notions that sometimes the right kind of Slack matched with the right kind of innovative effort is at play. And you can kind of see how this research began with a simple idea and it's become more and more subtle, and we've learned how to categorize Slack and innovation effort and subcategorize it and sub-subcategorize it. That's really the research. It runs over about 40 years or so. The inconsistent findings are ones where once I get outside the US, I start seeing things where they don't line up the way I thought they would. Meaning, I thought more of Slack, whether it's absorbed in the form of people or unabsorbed, we have cash or securities, should induce more innovation. But there's research in settings such as, well, in Korea, where, yes, that's the case. More cash leads to more innovation. But there are other settings, studies that are remarkably similar in places like Japan or in Mexico, right? How different are they? Where you find either inconsistent or the opposite effect. I need absorbed Slack, this kind of people, or I need less in the way of this unabsorbed, flexible.
That's pretty remarkable that Japan and Korea would have different results.
Exactly. We look across, or the U.S. and Mexico. This is a story. This one story and study out of Mexico, which is from a study published in a management magazine even a year ago, is really about maquiladores plants. These are plants on the border. So these are plants that are sitting within a few miles of the border with Arizona and Texas. And yes, they're in Mexico itself, but they're controlled, largely speaking, either directly or indirectly, by U.S. interests. So go a few miles, and some things are changing, and we don't know why. Or I should say, we haven't bothered to know why, because largely this research has never been cross-country in this notion. We've always done it in the U.S. We've always done it, if you did it at all, you did it in Mexico. To some extent, we've oversimplified things, but so much of our work that's so important. I think some of the most important work is, just as I said, it crosses collegial boundaries, it's got to cross country boundaries. We need to be able to say things comparatively, or else we're in a world where we can just tell narratives about one place and it's potentially irrelevant elsewhere. That's silly, especially in a world where we have international regimes and the like. Yes, question?
It's more just a query. How will we distinguish between Slack and surplus?
So I'm going to use the term. I'm not sure what you mean by surplus, but I'll use this way about Slack. I'll use this way to describe it. It's about the things that we don't need every day, but it's the things that are in the offing. They're just outside the door of this seminar room. And what they allow us to do is to carry on with our work here, with the resources we have, but with less oversight. Because why? Because if something unexpected happens, the firm has a bad quarter, other types of things happen, there's an increased spike in demand or drop, those resources are there ready to step in and buffer what we do. Maybe they're cash in the offing, ready to come and buffer what you do. Or maybe they're people. And I'm going to talk about how cash and people, absorbed and unabsorbed, Slack, differ in the way they motivate you to get your work done in this room. But in effect, they're there to support you. They're resources in the offing.
So, how did you measure Slack? Like, you measured it, or you asked the firms whether their view of Slack or your calculations?
So, well, it's a great question about how we measure Slack. And that's conceptually how I'm describing it for you. I'll show you in just a little bit how we measure it and get at it. And it's something which is related largely to the availability of information that comes from publicly listed firms. It's going to be financial, it's going to be information that comes from the balance sheet, income statement, and other disclosed issues. But to the extent that we use this, it also coordinates closely with other research that's based on survey methods and questionnaires. You know, one of the things I think interesting findings about the resource-based, or pardon me, the BTF and SLAC that motivated this is Joel, who is a former doctoral student of mine, therefore has been reading the literature much more closely than I. You know, there are papers that come in and go, I think this might be a way to think about this and answer this question. And in Joel's case, I think one of the neat things is looked at a paper around how differences in the nature of ownership in firms, family ownership versus institutional ownership. The Vaaler family has a 40% share in this company, and 60% of it's owned by other people on a share market listed, whether they're an insurance company or individuals like you all. And one of the interesting things that comes out of that is that it ends up the nature of ownership, the nature of who's actually in control among the owners, has a real impact on the effectiveness of SLAC for innovation purposes. So that got us to thinking. One of the things that differs is about how shareholders are empowered or unempowered across countries. But of course, shareholders, they're only one group that can materially affect the outcome of a firm. And we think of another, unionized labor or employees, who have all sorts of influence on what happens inside of a firm, but not through the ownership relationship, at least not necessarily. And that's where we get to these really interesting cross-country differences, not just in how we protect or don't protect shareholders against the insiders or managers and the like, but how employees are protected, say, in their jobs, in what they do, or whether they can be terminated and the like, or plant closings. These types of things are also ways, and that's really interesting because in the behavioral theory of the firm, that's a picture of Jim March in the 1960s, working these big, huge computers. Jim March is writing this theory. He said the way to think about ownership and control of the firm is to think about the firm as a political coalition. It's the top management of the firm is a lot like the top management of a political organization. Who's ever in the coalition gets served by the bureaucracy. So think of the way Washington works. Every 4 years it might turn over with who's in the White House, but the bureaucracy is always there. So think of management as the bureaucracy, and then who gets into the central positions of power in this political coalition we call the firm. And shareholders almost certainly are part of that. And certain types of shareholders have more or less sway. But in certain firms, especially by countries, shareholder or other non-shareholding stakeholders may be there, like employees, union members. For example, in Germany, the old co-determination idea that puts a member of a union on the board, even if they don't own a darn share in the company. That means they have a say in the information that comes out and maybe even in strategic decision making. The idea there is maybe if we understood who was in the coalition and how they were empowered, we might be able to sort out some of these funny, inconsistent findings. If it's a place where employees are much more central to decision making, or at least able to stop it, then maybe that would explain why certain kinds of SLAC are magnified in their effects and certain others are diminished. And likewise with shareholders. That's the idea. That's what motivated us with this work. So what I want to do is just show you a little bit of the kind of theory overall and talk about that and then show you some evidence. So we'll spend about 20 minutes or 20, 30 minutes and then we'll just talk about the research. So I'm going to show you some lines and arrows and some pictures that I think kind of capture this. You know that line, was it from the UK during the Second World War? I think it was kind of keep calm and carry on. That was during the Blitz. And so there's all sorts of things that say, keep calm and throw money at the problem. So pretend for a minute we're actually in a room, in a lab room, and we're working on a long-term investment project for a company. And that takes time. And that company has ups and downs. And there's the stock price or sales for that company from year to year. In that world where there's any volatility, SLAC resources become so important because they buffer. They give us flexibility in a world where we can't predict what's going on. They help us kind of make the highs a little bit less high and the lows a lot less low, and let us carry on with this long-term work. So one really important, just direct relationship is with especially unabsorbed SLAC, and that's the fancy word for cash. Easily liquidated liabilities that sit in the offing. This is the ultimate flexibility. No matter what I face as a firm, I can keep these people at work as long as I've got stacks of cash in the offing to support them. And then I don't have to watch them very closely because I've got those stacks of cash there. And I can let them do the playful, important, creative things that are important to the long-term viability and success of my firm on that. And that's really just what this says. It says those scientists are happy when you can keep calm and have more money to throw at the problem outside the door. And that's just the basic hypothesis. And likewise, think of outside our door, it's not so much cash, but it's other people, more scientists. That's also something that's helpful to us and allows for less in the way of monitoring, but the mechanism is different. Whereas the first, cash, is there and induces less concern because I have all this flexibility. They just grab cash and throw it at the problem. Having people as the surplus, I think is what you were saying earlier, sir, is a different type of, it's a commitment mechanism. Because people, scientists, only do certain things, right? They work on lab and long-term R&D. It's a commitment mechanism. If I say what I'm going to do is have lots of great personnel, HR, human capital outside in the offing waiting for you, I'm saying two things. I'm going to support this, and by the way, it's going to be difficult for me to renege on that commitment. Things, and I'm going to make some assumptions about those shareholders, especially about a certain group of shareholders. Non-controlling, call them transient institutional shareholders. Those are three different words important, meaning they're not necessarily insiders in the company like managers or really large block holders of firms. There are also people that move in and out. They're not there for 30 years. They're there for 5 weeks. They move in and out every day, either through their brokers or through their mutual funds. And then the other thing about this is that since they're minority shareholders, we have a higher degree of certainty that the returns they're looking for, the financial returns from their share investments, and not necessarily many of the other kind of knock-on effects that go with an insider who has strategic control. If I've got 50% plus 1 of a firm, not only do I have 50% plus 1 of the returns, but I have essentially the ability to redirect the firm if I want to. Not these guys. These guys are, to some extent, they're buying a lottery ticket in this firm. And so the assumption we have about these shareholders in particular, but you might talk about shareholders more generally, is that they look at long-term investments such as the ones you're making here in this lab room with a little more, I should say, constructive skepticism. That maybe they're looking at how the opportunity costs of allowing you to play with this for purposes of some new breakthrough innovation that comes out 10 years from now versus a little bit higher dividend that paid to them in the next quarter. Or maybe other types of cash that could be used for more immediate purposes, especially if I'm a shorter-term institutional transient minority shareholder, right? So with regard to the value of slack, of that cash sitting outside the door, they're going to be more constructively skeptical about it. They're going to ask managers to exercise a little more monitoring. They may not allow you to have easy access to that cash. They may ask you when times do get tough, they may be a little more nervous and ask you to either cut back or abandon that project altogether. The aim of this is to demonstrate that stronger shareholder rights are likely to diminish the positive effect of having lots of cash on hand. That's the simple idea. And they're going to be especially that way with regard to if it's people out there. What are we doing with all these scientists on call? I mean, those are salaries and benefits that could be going to dividends or higher earnings in the quarter. For the same reason they have constructive skepticism about Slack's support and the offing when it's so flexible as cash, they're going to have it with regard to those commitments. Those are the wrong kind of commitments, or I want to be more careful about how you make those commitments, management, and they'll exercise more oversight. So in both cases, higher, stronger shareholder rights are going to diminish that positive effect that Slack, whether it's absorbed or unabsorbed, that is money or people, has on innovation effort. Okay? What about now, throw shareholders out for a minute. Let's think about employees. Think about how stronger employee rights would change the way they would be motivated about having all that cash outside the door. That one's not as straightforward. There's a story we could tell. That would say maybe they would let that more cash out. After all of you working in this room on that R&D, you're employees too. You're in a lab coat, not necessarily in a hard hat, but we're all in this together. You might kind of think of it. On the other hand, cash for that long-term R&D investment is cash that also could be restored to other kinds of things that are more directly applicable to employees, starting with wages and salaries and the like. Now, shareholders who aren't happy, who don't like all that out there, they exercise their disdain for that through their votes. Votes that could essentially fire and hire management if they don't like it. That could redirect the company through the board of directors that they appoint. It's a little different here. You know, employees with stronger employee rights don't necessarily hire and fire management. They don't do that. But they have a kind of series of rights that they can use to stifle management initiatives. We call it you think of in the legal philosophy, a guy named Ronald Dworkin used to talk about rights as trumps. So for those of you who are bridge players, you know all about that, right? So you want to try and cut back on the amount of money that's on your, I'm going to play a trump. Stop that. You have to consult with me. I'm going to play a trump, all these other things. In this case, we like to think that the cash on hand that can be redeployed, perhaps to employees, therefore will be diminished in its effect, its buffering effect on that. But to some extent, I'll say this is kind of a weak story that I want to tell for it. Here's the stronger story. Stronger employee rights is going to reinforce that commitment mechanism. That is, it's not going to say, I'm more reluctant to keep employees outside of the door from the offing to support this activity. It's going to say, you keep them out there. Those are my brothers and sisters, and we want to support their activities in support of what goes on here in this lab room and innovation. Stronger employee rights will magnify the innovative impact of more slack in the way of people outside that door. That is maybe the kind of biggest claim. Maybe it's intuitive. It's also kind of a claim for which the evidence we want to look especially close at. It's one that, for research in regulation, law, and finance, has not been the centerpiece. More of our work has been around how laws empower shareholders and then how they change the behavior of the firm. Less so with employees. And I think it's because the mechanism for employees to affect the direction of the firm is at best indirect. It's playing those trumps. It's saying, no, you can't do that, you can't do that, you can't do that. What's that Sherlock Holmes says? As soon as you eliminate all the other alternatives, then whatever is left, however improbable, is how the crime was committed. It's a little bit like that with employees at directing a firm. They play those trumps, and then you as a manager are left with maybe only a few paths for which there isn't this barrier, and then you go down them. That's the mechanism we think is at work here, especially with regard to human resources, people as slack. It magnifies the commitment, it keeps management, it keeps you in this room innovating, even in the toughest times. Okay? So that's our story. Now I'm going to give you some evidence. I'm going to show you how we generate it. Just don't worry so much about the Greek. I'll just show you some pictures in a second, which I think capture what the Greek tells us. Pretend now what we want to do is we want to, on a broad sample statistical basis, analyze trends in firms across countries with regard to how slack of an unabsorbed, that is cash, or of an absorbed, people, affect innovation efforts. So I need some variables, I need some measures, as Waleed was saying. So here's a measure. On the left-hand side, I've got something called R&D intensity, and that's a standard way of measuring innovative effort. It's the input, it's the amount I spend on research and development as a percentage of sales. So that's pretty standard, okay? Now, on the right-hand side, there are lots of different variables to explain that in this regression model, but the two, I think, important ones are financial slack and HR slack. HR is human resource, people. So financial slack is essentially the current ratio of the firm. So if I were to look at the balance sheet of a firm on this, I would get the current assets I can liquidate within a year, and current liabilities that are coming available then. And we can think of the public organizational analogies to that, right? Because public organizations, your municipality, your government agency, they have balance sheets too. So that's really essentially, do I have lots of cash on hand, lots of flexibility, or people grabbing at it? R&D slack, or pardon me, HR slack, is about people divided by sales. And you might say, boy, that's pretty rough and ready. That's the standard in this field. It's looking at the number of people. Sometimes if we know it's the number of people of a certain educational background or sort, but generally number of people divided by sales. And it gives us a sense of the individuals per dollars invested, a kind of productivity approach. There are lots of other things in here to control for other things that affect R&D intensity. I'm going to ask you for a minute to suspend, your skeptical belief about this and just say, yeah, okay, he's got most of those covered. And now what I want to focus on is what? I'm going to focus on the impact of financial slack and HR slack on R&D intensity. Both of them should positively affect R&D intensity. More money, right? More money on hand, more people on hand should be good, just like in my little story for it. And there are ways for us to think about and control for other things, especially things that are peculiar to the firm that we can't observe. So in this model, we have something called firm fixed effects. It's essentially kind of taking out the average effect of everything that's unique to all the firms in the sample over the period of time observed, leaving only the things that vary within firms for me to deal with on that. Yes, question?
May I ask a question to clarify that? I understand that this research is based on both quantitative and qualitative research, and you also want to measure the innovation effects from the SLAC resource,
That's right.
including the cash and the financial and the human resource.
Yes.
And your variable is more based on the expenditure or sales. So what exactly the definition or the meaning of innovation that you mean?
That's a great question.
It means from my understanding, it's not only the sale or the benefits of the firms, but for the customer, for the beneficiaries, and for the society, like social responsibilities and other kind of thing that is more innovations for the firm to contribute to the country, to the society, and other things.
That's a great question. It's Pratana, is that right?
Pardon?
Your name is Pratana?
No.
Putama
Pratama, thank
from
you.
Laos, because I'm working both with the government organizations and recently I work with United Nations. So I really skeptical and want to know how public-private partnership that works in my
So
country.
thank you for the question. Let me simplify it, I hope not oversimplifying it. That is what is it, why use, if R&D intensity, is that innovation? That's an input.
Right.
The things that we care about are often the outputs that go with it. We care about, here's an output, new products, new services. Here's another output, patents, copyrights, trademarks, other things that we think are underlying and that are associated with it. And the short answer to that is, the theory tells me so, but I'm going to try not to just rely on that. So in the behavioral theory of the firm, what they're trying to explain is innovation effort, the inputs that go with it. Now, so in other words, more slack in the way of money or people in the office means that I'm going to try harder in this room, or I'm going to try longer without being interrupted by management. And the theory is attempting to understand that behavior within the firm, but I think your implication in the question is so appropriate, which is what's being produced useful? Useful for the firm, useful for broader society, and we have a number of different ways we try to measure that. So in one of the ways, at least that's more and more popular in the business school, and I think it was appropriate here, is to look at outputs that are accessible. So one of the increasingly available measures on a cross-country basis are patents that are produced. We think patents is a great way to get at that. Here's the problem with that output, is that the US is great at that, and certain other countries are pretty good at that, but most of the world is still not so great at how we meter intellectual property in the form of patents and formal patents. Another related issue with that is that still much of what we produce in the way of innovation may not be patentable or trademarkable or copyrightable. That is, it may not be appropriable under legal regimes. There are lots of things that we produce that are just kind of out there with it. But that world's changing, and one of the things in this research that we do to check on that is within the realm of, say, patentable countries where we have regimes for which we can observe this, we can run with a smaller sample these same results, and they tend to come out the same way. But I think it's a fair point. At the end of the day, I'm using innovation, but I'm really saying innovative effort, the inputs that go into it. And I'm assuming that even if sometimes the things that firms produce are useless in the end, that systematically more innovation effort leads to more useful innovation. That's an assumption about it. And it's a pretty fair assumption where the research would suggest more R&D leads to the kinds of things that firms value, better products, better services, better patents, and also leads to the kinds of things that societies value, better educated workforce, more productive workforce, faster growth. That's the assumption on this. You had a question, sir.
Yeah, very small query. This the function which we have given, basically the primarily vendor storage is a basically combination of financial slack, primarily the cash and whatever we have the current assets.
This is a simple story. This one I'm telling you here.
Yeah.
This is essentially recreating what we know in the research.
Basically, the complexities lies in those betas. How to calculate those betas.
Yes.
The problem is that. But
we'll get to that in just a minute.
But I want to understand this particularly. This is the potential of the firm, or it's the actual happening in the ground. Means the R&D intensity which we are going to get by putting all these variables in the picture. Then we get the potential of firm to innovate. Or it's basically innovation which is going on there, we are going to get.
And we're going to get, what we're going to derive from this is we're going to derive, on the right-hand side, these are inputs that come before the, we're going to derive an explanation of trends across, in this case, about 7,000 firms, almost 7,100 firms, across 29 countries. That is, what's the relationship from an additional unit of financial slack or HR slack to this intensity, this innovative effort. So I think what we're going to do is we're going to explain variation within firms in terms of how hard they try within here to develop new products and services as a function of these two elements, and then lots of other things which I'm going to abstract away from for a moment. And then the tricky part comes, because now I'm going to have to take those firms and then understand how they're moderated by country factors which are aggregated above them all. So that's the easy thing. Okay, here's the easy answer. Not surprisingly, more financial slack, you get, right, it's positive and significant, you get more activity, more HR slack, more people, you get more innovative effort. That's easy. But in some extent, this is, you know what this new about this? Is that this is doing this on a pooled cross-country basis. Or the panel. Nobody's done that work before. Nobody's published that work. It's kind of surprising when you think about it. But it tells you about how we work in our little geographic silos. We don't want to do this work. And maybe it's because of this problem coming up. This gets at your point, which I think is really about. This is the tricky part methodologically. So I've got firms nested inside of countries. I've got a bunch in India and a bunch in the US and 27 other countries that come with this thing. So now what I need to do is I need to disentangle the firm effects of more financial slack and more HR slack on that output. I just showed you that. From the effects that are tied to being in a certain country. And there are different ways of getting at that, all of which kind of leave you unsatisfied. And there are ways of controlling for some of this and not for other of these things. It's a real methodological conundrum. And I'm going to show you what we came up with as a strategy, and the gentleman anticipates with this comment, which has its own trade-offs, but I think they're trade-offs we can live with. Here's what we do. We're going to estimate that same equation again, but we're going to do it for each of the 29 countries in our sample. So now at the end, we've got 7,000 firms. Well, a lot of them are in the US and Canada, but there's still substantial numbers in each and every one of the 29 countries that we have. A lot of them from the OECD, but also some from kind of classic emerging market developing countries. What we're going to get is we're going to get 29 betas, estimates of financial slack effects, one for each country, and 29 of the HR slack effects, one for each country. Then we're going to take them and put them in a second stage equation. This is what they call an estimated dependent variable analysis, a two-stage analysis. And in that second stage, we're going to have essentially the average effect of one more unit of slack, of financial nature, as the left-hand side variable. And on the right-hand side, I'm going to have something called, this is this fancy word for regulatory protection, National Corporate Governance Institutional Protection. And in one case, NCGI, it's going to be about how strong are your shareholder rights in that country. In the other instance, I'm going to show you some estimates where it's how strong are your employee rights. And there are some interesting developments in how we measure that. A standard measure for shareholder rights comes from work that goes back to the mid-1990s by a group of 4 economists, Florencio Lopez of Solanas, Rafael Laporta, Andre Schleifer, and Robert Vishny, LLSV, who are kind of this 4-man army of research out of economists trying to correlate differences in laws and regulations with all sorts of financial outcomes and economic outcomes. The countries with this kind of law grow faster. The countries with these kinds of laws have more banks. The countries with these kinds of regulations have broader stock markets. The law and finance tradition. So one of their contributions is to empirical research to measure, essentially on a cross-country basis, the strength of shareholder rights. Kind of a 1 through 6 measure that's based on how much in the way do you give minority shareholders the right to have a say to those insiders, heavily invested insiders and directors on that. And I think that's one of the really interesting contributions. Some work by labor economists and LLSV, led by a guy named Botero, did the same for cross-country measures of employee rights. So it's things like how easy is it for you to fire somebody, or to reassign somebody, or to deal with grievance systems. You know, any of us who have ever managed a company or managed a group where there's some kind of collective bargaining arrangement or other protections, you know, we know all about those things. So same kind of standardized measure, in this case based on 4 different components. In both cases we standardize those. So 0 to 1, where 0 is very few rights and 1 is strong rights, in both cases. So think of regressing now. The beta, that's the marginal effect of one more unit of, say, money, dollars, on innovative output. I'm going to regress that coefficient on this NCGI measure, how strong are your shareholder rights in your country, and then on a couple of other things. And you can already see what the trade-off is here. The good news is I have these marginal effect estimates by country that are based on sometimes dozens, often hundreds, and in a few cases thousands of firms. I've got great precision with that estimate, and I've got them at the firm level, controlling for firm-specific effects. That's the good news. Not the bad news, but the limitation you have to admit is you don't have thousands of observations. Once you bring in countries, you only have 29, because you have 29 regulatory regimes that potentially differ. So in that second stage, my power to estimate, in this case, the coefficient on the left that I derived from the first stage, is limited in terms of its power to the 29 countries that I have. So that's a trade-off. Now, that's not a showstopper. It's just something you admit. I'm going to show you how that relationship works in a simpler regression model, but more importantly, I think the pictures, are really powerful. Oh, by the way, some types of betas, about financial slack and HR slack, they're estimated with great precision, and sometimes they're just not. And we want to account for that. And that precision isn't merely a function of how many do you have to estimate each country model. There are other things. So one of the innovations with this estimated dependent variable approach is that you can account for that. The second stage is a weighted regression, where I'm going to give more weight to where I put that line running through that cloud of data based on how precise the estimate of the beta is, the left-hand side variable for the first stage. And that's what the Greek down there at the bottom is essentially capturing. It's looking at how much random variance I have in those estimates and how much variance I have that's tied to some of the country-specific factors in it. So that's the good news. We're kind of trying to think. The trade-off here is power, and I think the real strength is the ability to develop preliminary estimates based on all sorts of firm-specific characteristics. Remember, I'm sitting over in a business school. We care a lot about differences in firms. So we want to bring those over here. And if I were sitting over here at the Humphrey School, maybe I'd be all about the differences in countries and less so about them. But this is how we work in this business. Let me show you some pictures. These are really helpful. These are 3-letter abbreviations for countries, many of which are intuitive, like ITA for Italy or GRC for Greece. Others you got to kind of go around a little bit, like the Switzerland will always be the Helvetian Confederation. Right. So this is just the international designators for it. Here's what I think is useful. So ISR is Israel, for example. If it's blue in a square, then that is an observation of 1 to 29, which is based on an estimate of either financial slack or HR slack from the first stage, which is significantly different from 0. It enters positively. If it's red in a hollow circle, that means it's another observation, but in its firm-specific, in the first stage when I did a firm-specific regression, financial slack didn't enter significantly, or HR slack didn't enter significantly, right? It's more about it. So those have, by definition, they have less influence on the ultimate line that I produce, and you'll see why. So, but here's the broader trend. This first trend is with regard to what? It's the regression of financial slack on those shareholder protections. So stronger protections means shareholders got more of ability to say, stop, don't do this, or be more careful, don't just let these guys go off and do whatever they want. That's money over there, that could be ours. And so the hypothesis is that less in the way of those rights means there's more in the way of innovative effort for an additional unit of financial slack. Okay? And as you go further out, it should be a line that slopes down to the right from upper left to lower right negatively. And yes, and indeed it does. And what you see is two things. You see the negative slope as shareholder rights improve. That means the marginal effect of one more unit of financial slack goes down. You get less innovative effort for that. And you can kind of see some of the suspects might be intuitive to you, others may not. Right? So Italy and Greece don't have the same level of shareholder protection as, say, in Japan or Great Britain. And we see that in those countries there's also kind of a trend line that suggests that there's more innovative output per unit of slack input. Okay? And that's confirmed in a regression that includes a couple of important things. That same shareholder rights, that's the NCGI effect, which is negative and significant, and then some other things. And I might add, you know what the most important input in the second equation is? It's the constant. It's that kind of where does this line cross the y-intercept? Because that's capturing, essentially, the average level of innovative effort in a firm in that country. And then what the shareholder rights NCGI variable is capturing is, what's the marginal change in that as I add, right? What's the marginal change in that as we move along with stronger or weaker shareholder rights? The other things that are in there are kind of other simple things. We could argue about what goes in there. We try lots of other things that yield the same results. But we get this negative relationship. Stronger shareholder rights diminishes the impact of financial slack on innovative effort. Simple. Here's the same thing. Stronger shareholder rights now and the impact of HR slack, having more people in the offing. Look at that, boy. Almost all the countries enter significantly, and you see this very pronounced negative trend, as predicted by in the research. Which suggests again, and as you see, confirmed again in the multiple regression, that is, after I control for the overall level of innovative effort, then stronger employee rights, the ability to say no, don't do that, or shareholder rights, the ability to say no to putting more of these people in the offing means that you also diminish the innovative effort per unit of person, per unit of additional scientists in the offing, or administrator in the offing, or employees more generally. Again, kind of following the kind of the framework that we laid out, and that interesting, sometimes divergent logic, the slack as flexibility and buffering versus slack as commitment. Shareholders undermine both, and they undermine it for some of their own purposes, not surprisingly. And if they're given more power, they're more central to the coalition, this is what they do. This is always the hypothesis that you kind of go back and forth. Is now it's about stronger employee rights, and the thing we're trying to explain is that the marginal impact of an additional unit of financial slack and innovative effort. And here, there's a slight negative, very shallow, but lots of both significant and insignificant effects. And what we find essentially is there, you notice, if anything, not a substantial effect, and here there's no significant statistical significance at commonly accepted levels for that effect. It's negative, as we say, but it's probably noise. There's a good chance of it. So to some extent, that diminishing or that moderating effect that we thought we see, it's there, but it's not in any significant way. So I wouldn't kind of say that there's any strong support for this hypothesis number 5.
Well, could you say very briefly, what the constituents of masculinity are?
Yes. For those of us who study culture and management, and it's only in the management school that this occurs, one of the touchstones of that research is research that goes back to the late 1970s in a book called Culture's Consequences by a Dutch sociologist, anthropologist, who, as part of his research, named Gerda Hofstede. And just before you say, well, what's that?
He's very well known.
Of course, right? The book sold more than the Bible. It's like those late night, whatever. So, very important work. And that work distilled first through survey evidence and through multivariate methods, essentially different components of business culture down to 4 broad elements that was then added to a 5th element, one of which is the degree of national culture in business that is masculine or feminine. And it's a kind of a story about the role of the individual and how individuals take decisions within a business context. There are others that go with this. Another one of these
are these all hosted as...
Exactly. These are.
I couldn't remember, but
Yeah, that's right. So why use them? We use them. It's almost, I shouldn't say it's unique. It is distinctive that management research uses those, whereas in other fields, even within the business school, there'll be alternative measurable indicators of culture. They may be based on religion or ethnicity or
But you think that some of these things might be applicable in public administration?
Absolutely. Right? Hofstede's work originally in the 70s was based on observation of individuals in the big multinational that was available to them around the world, IBM. But certainly IBM isn't indicative of every firm, or for that matter, any government agency. But these measures have proved to be quite robust to a number of different settings that relate to it. So why are they in there? They're in there in part because of where I come from in terms of a management school looking at them, also because they capture national level traits that are tied, at least plausibly, to business activities. That's, I think, the other thing.
So but these were all his original classifications?
Yeah, individuality versus the group, power distance. If I'm somebody who's a manager and you work for me, depending on where we are in the world, do we spend more time socializing? How unequal are we between us, perceived between us? Uncertainty avoidance, a nice one, which is in a world where I have to make bets about the future, how much do I care about the downside risk that goes with it? And we can tell stories, and I think they're, without simplifying, that there are some substantial differences in the way we think about downside risk and make investments in things like R&D that might be tied to whether you're a firm in the US versus Japan versus South Korea. So that's where they come from.
Have those indicators changed over time?
They're updated from time to time. Yes, they are. In fact, one of the, I think it's the uncertainty avoidance, or maybe it's there's one that was brought in the late 1980s that's related to the Japanese experience, had to do a kind of patient's long-term view that goes with it. So they're updated from time to time. And again, they've proven to be quite robust across business organizations in different settings, in different industrial settings, not just IBM, but they began with IBM in the 70s. One of the things that I've not shown you here is that you can replace these with lots of other indicators. Depending on the crowd that I present this to, you'll often see them say, no, you need other national indicators. So for instance, the strength of patent law protection is a great one for it. And I could plug that in and get the same results. Or the strength of union rights. And in fact, in the paper, we have a nice redo of this based on union rights that is collective labor law protections as opposed to individual employment protections, which is what we're using here. So I can pop in just about whatever you have out there that meets your fancy. I just can't put them all in one place. I got 29 observations that work on this. This is the really fun one here, because I think this is the most interesting outcome, certainly one that sparks most, I think, comment. So this is now the strength of employment protection on the x-axis, and we have the marginal effect of an additional unit of HR slack, of people, in terms of innovative effort. And you see this quite clear, positive effect running as employment protection increases. I'm getting more in the way of at least innovative effort, R&D intensity, per unit of additional HR. And I'm going to talk about how that can be interpreted differently. But what it tells us is there is this positive relationship consistent with the hypothesis, and indeed, when I put it in multiple regression, it's confirmed that. Just to give you a sense that these are not just numbers, but they actually kind of, what is the substantial impact? So the substantial impact, I think, here is that, think of a bunch of firms in this study where the average R&D intensity, left-hand side, is 5.1%, meaning you get about, was it $5 of R&D for $100 in sales in the company, $5.10. So if I want to move that up or down, okay, and I'm interested in, I'm going to add more financial slack or I'm going to add more HR slack, and I expect that R&D intensity to increase. Okay, and so now I'm going to show you how if I increase financial slack, in this case 1 standard deviation, kind of from the mean level to up to about the 67th percentile, from 50 to 67, what happens? Well, what happens is R&D intensity does increase if I have weak shareholder rights. It increases about 0.5 percentage points, from 5.1 to 5.6. Okay. But if I have strong shareholder rights, it zeroes out. I get nothing for it. I get absolutely nothing. There's that work. There's that work, in the offing, saying, look, I'm going to look askance at that. I look with skepticism. Now look over here. Same thing. Now I've got HR slack that I'm going to put in. I don't have anything here because the betas for those analyses weren't significantly different from zero, so they don't really shouldn't be the basis for interpretation. All these work. So now I have HR slack, more people in the offing. I'm going to add more people to this. Oh, I've got weak shareholder rights. In that case, I increase my R&D intensity by 3 percentage points, quite substantial. But if I have strong shareholder rights and I put more people in there, same amount, I only increase it by 1 percentage point. If I have, in this case, and I think this is kind of interesting, if I have weak employment protection, I add a bunch more people, standard deviation increases, I get 1.3 percentage points more of an increase. And then this is the practical impact of this relationship I just described for you and graphically illustrated for you. And that is, if I increase the number of people in my company, the HR slack, if you will, by 1 standard deviation, and I'm in a strong employment protection, right? My R&D intensity increases by about the same as 0. Weak shareholders, strong employees means more in the way of a marginal impact on innovative activity, and we like to think innovation from adding more slack. We can magnify these effects. We can, if you will, double their effects, or at least we can increase them substantially for them. And we can zero them out. If we put them, if we add people with the if you will, the right, if you believe in the strength of shareholders to kind of hold management's feet to the fire, make efficient investments, or if you will, to kind of increase short-termism and to the detriment of the firm's long-term ability, if we have strong shareholder rights. And I want to address that because that's one of, I think, the interesting alternatives, the way of interpreting. But I'll take the points. Yeah,
Can
ma'am.
you go back to the table, please? That you just talk about the interpretation for these results. I want to know more about the strong employment protection or weak. That means it's just the number that you say that increase the number of people or increase the quality of people, like educations or other things?
No. So what it is strong and weak is this. Literally have a mean level of shareholder protections, the NCGI for shareholders. Is a number that varies between 0 and 1. And what I can do is I know what the sample mean is for every country. And what I'm saying is if I take all the countries that are 1 standard deviation above that mean, I'm going to call those countries strong shareholder rights countries. And if I take all the ones that are 1 standard deviation below that mean, they're weak shareholder rights countries. And then what I want to know is for a firm in one of those countries, how does it differ in terms of the effect? Yeah, there's all the stuff in the middle too, but the interesting thing is to look at the extremes. So that's weak and strong.
So you mean in terms of the number of people or in terms
No,
of
in terms of the protections,
decision-making?
the regulatory protections that they have. So do they have, if your country, say Italy has weak shareholder protections, very strong employee protections. So they'd be somebody that would sit at those 2 extremes.
Like social protections, like health care benefits, or what that's?
It's around, for employees, it's largely around hiring and how hard it is to fire them and reassign them. That's what it's around. Okay, and for shareholders, it's their ability, especially minority shareholders, to kind of get directors and other insiders to take notice of them and to be able to redirect them or fire them.
Primarily, we can say strong employment protection in the government sector and the weak employment protection in the private sector. If we take the analogy.
I think there is something
like
like
in the
that.
government, the bureaucracy, it's difficult to fire a person, equally difficult to hire a person.
I
In
think
the
you're right.
private sector, it's easy to hire and easy to fire. Means
Yeah.
in general trends
Right.
across the countries.
And what's important about this is that, we have countries that will say, in fact, we have presidential candidates that will say, hey, I know how to beat up on unions and employee rights, right? And that's a good thing for business. It gives great flexibility. The suggestion here is that maybe that guy's wrong, right? Because if you have protections, these are also people who we like to think become more productive, like professors. But we'll talk about that in a moment.
I have a small, on the same.
Yeah, but I do want to make sure, I'm going to deal with
I have
it.
a
Yes,
small
sir.
query on
Yeah.
this. Means how, there are 2 primary factors for your R&D intensity. One is the financial slack, and another is the HR slack, absorbed or unabsorbed, if we talk differently. What is the proportion? What is the ratio between these 2?
Yeah, so
To the R&D intensity, the contribution to R&D intensity, what is the proportion of which particular factor influence the R&D intensity is in a more stronger way? Is it financial slack or it's the HR slack?
that's an interesting question. I'm trying to, now you're catching me a little bit too late into the presentation for me to recall what the real movements are, especially at the mean level for that. I think it's HR slack actually, in terms of being able to move the dial on that. I think, but I want to give you, in the paper we describe, we play out some scenarios other than just these, give you a little sense of it. But I think it's around HR slack, and maybe that's not surprising. Maybe that's not around surprising for it. Hey, here are 2 ways to read that HR slack effect. This effect here. Okay, one is this. And this is the critique of somebody who says, hey, we need strong shareholder rights, we got to bust the unions, we got to make employees employee at will, because otherwise you'll never be able to fire these guys. So this is a critique that comes, what they call a creative corporatism critique. And it's kind of a story about how, in the varieties of capitalism, there's a kind of capitalism we tend to think of in the US, which is about free markets and fewer protections so that managers and individuals can have flexibility to do what they need to do, right? to some extent, there was research here suggests, wait a minute, we need management, maybe needs to tie its hands a little bit. Maybe employees are empowered, they're going to be more creative, more artisanal, more of the things we really want. So in other places, many political scientists, for example, comment on how Scandinavia, Northern Europe practices this. Think of a world where management can find more productive employees and more public capital financing for their work if they give employees a little more job security. And employees get that job security and protections, but they have to commit to a continuous education, and then government funds both. Government funds a good basic human capital system, K through 12 in the university system, and government also, along with business, pays for kind of continuing working training. This is a kind of part of the broader corporate capitalism story. And if you have that along these lines, that's consistent with many of the countries that have the same kind of
But you added another
competitiveness.
variable there, right? I mean, you said that in addition to just giving them protection, there's something else
Right,
going on.
and that's what I'm
So
saying.
it's a proxy then.
It's a proxy. It's consistent with it. It's one of the things you observe. You see the countries that are out there are these countries. So that's one way. That's the optimistic view. Here's the other view, which is you have lots of innovative effort. You're essentially throwing useless resources at people you can't get rid of otherwise. So, as I've got a bunch of very protected, very, I should say,
This is
entrenched.
out of date now.
Yeah, I know, of course. But I've got a bunch of entrenched employees who can't go anywhere, so I give them research to do. And they sit around working on research that goes with it, because it's all about the innovative effort and not necessarily the output for it. And that's also consistent with those results. Okay? It's a real kind of different government for it, but it is.
But this gets back to the question of inputs and outputs, right?
Right, and this is, the research is about inputs, although
Yeah.
we know most of the research has to us R&D intensity as an input is also associated with R&D output.
But to get back to your Italian example, so in Italy is ground zero of the maximum contribution of SLAC resources to innovation?
No, I think it's one of the ones that are both on the extremes of either one of those. There are some countries for which they're strong in both. That's one of the things. It's not just, they're not all sorted, you're either one or the other. It's not.
No, but isn't Italy?
But Italy's a great example. It's a paradigmatic example. Here's a little study. We leave this with you as you think about sorting out these two scenarios. One of which is quite kind of optimistic, the other quite constructively cynical. So what we did here is we took countries that were at the top of the employment protections, the top 25%. Those are in the blue. Germany, France, Netherlands, Norway, Sweden, Finland, the usual suspects. That's creative corporatism. I love this one. Indonesia is down there on the left. And then we took the ones that are at the bottom. Pakistan, Japan, Great Britain, US, Canada, Ireland. South Africa, right. So what's interesting then is, and then we draw two trend lines, both of which are positive. Because we saw the broader trend is positive. But here's what's important. The right hand, or the y-axis is the same, but the x-axis is a little different. This is actually the percentage of the population, of the working population, with a university degree. What we want to get at here, consistent with the scenario I described for you, is kind of broader human capital. Human capital that could be the product of this virtuous circle I described of creative corporatism. And what I like about this is notice the two lines and the steeper positive line that's associated with the creative corporatist countries as opposed to the ones that we don't necessarily associate with it. So what it tells us, I think, is if we want to distinguish between those two stories, there's at least some basic evidence consistent with that more optimistic story. Give them protections, they'll be more productive with that, especially if it's supported by a system that creates human capital as a matter of kind of public priorities and not merely training on the job. I tell you that because I think that's one of the things that, from a policy standpoint, is most non-intuitive, at least when I present this work to my business colleagues. That's not necessarily what they want to see. That's not consistent with free markets and employment at will and flexibility. That's associated with, kind of a workplace democracy and what it means in terms of giving non-shareholding stakeholders a greater say in the coalition that runs the firm. And that's what I want to leave you with, is how important it is to think in terms of firms and other organizations as political entities, and that in the politics of the coalition and building that up and the priorities for it, what happens in the national regulatory system matters. Not just the formal things I observe, but I think lots of invisibles and culture in that. And that helps us to explain that puzzle. That helps us to make the behavioral theory of the firm more important as a lens in the 21st century, useful for countries around the world.
Well, Paul, that was terrific. Great talk, and we want to thank you.
Thank you.
We always end right on time, folks. I think Professor Vaaler would be happy to answer another couple of questions if you have them. I found that really astonishing. I looked at the paper, but I didn't read it carefully when I first got it, and it really is amazingly interesting. But because of the message that it conveys, it's obviously going to be, subject to a good deal of scrutiny.
Absolutely. I hope it will.
So, you said that the corporations don't like basically what they're seeing, but is there any recognition that maybe they should change, that it would benefit them?
I'm going to rephrase that the corporations don't like. I say sometimes my colleagues in a business school setting, often a North American one, often that's informed by certain cultural norms that assume that greater flexibility for management and stronger shareholder rights is a desirable outcome to induce smarter investments. Okay, that's where I want to come at. But here's I think one of the interesting implications. There is a very interesting current policy debate about how countries and states within countries can attract businesses for investment. We look at foreign direct investment, or we look at investment in states as a way to bring technology, employment, and lots of capital. We love that, right? Minnesota and Wisconsin, the US and Canada, North America and Western Europe, the developed world and the developing world. We can think of those things. And one of the ways it's become increasingly, I think, interesting to attract that is to show how laws and other policies associated with them protect the rights of investors and managers to make decisions. That's very important. And you can see how, Wisconsin is open for business. The U.S. is the most desirable place in the world to be an investor. Western governments have rule of law that protect property rights. I'll take that all as well and good. And if you want to signal that in order to bring people to your country, the research here suggests that from the standpoint of strong shareholder rights, that may be attractive, but not for making long-term R&D investments. So let me give you another scenario. If I'm a company trying to signal that I'm making an irreversible commitment or a difficult to reverse commitment to a new technology standard, right? Where would I like to go so I could send that signal more forcefully that I'm tying my hands to develop that standard or bust? I might do that in a country with stronger employee rights, knowing that when I go there and locate there and set up my